Okay, imagine this. You take your crypto assets, your hard-earned digital money, and you deposit them into, well, basically just code running on the internet.
Yeah, no bank involved, no traditional brokerage firm you recognize.
Exactly. Just these things called smart contracts living on a blockchain. And then picture this code starting to generate returns.
And not just any returns.
No, like potentially staggering returns, the kind that make traditional finance look almost sleepy by comparison, returns that grab headlines globally.
That's the siren song, isn't it?
Yeah.
That's the huge magnetic pull of DeFi yield farming. It promises these incredible rewards.
But hang on, let's step back from that shiny potential for just a second. Because underneath all that hype about high yield, there's this landscape of risk.
Yeah.
And it's complex, sometimes, frankly, pretty brutal.
Absolutely. These aren't the risks you might be used to with, say, stocks or bonds. They're different. They're born from the very nature of these decentralized, code-driven systems.
Totally different challenges.
Fundamentally different, yeah. It's not like just putting your money in a trusted bank or, a regulated exchange. Very different ballpark.
Definitely. And figuring out how to navigate that landscape, really understanding both that captivating promise and the, let's face it, profound dangers. Well, that's what this deep dive is all about.
Exactly.
Welcome to the deep dive. Today, we're focusing specifically on yield farming, particularly in the U.S. crypto scene. We're pulling back the curtain, looking at what the sources we've gathered actually reveal.
We've got quite a stack here.
We do. We've got insights from risk management experts, deep analyses from crypto research platforms. There's a major U.S. government assessment looking specifically at illicit finance risks in DeFi.
Which is a big one.
Huge. And also valuable stuff from online forums, people sharing their real-world experiences, plus guides on spotting scams, and that always fun topic. Taxes.
That's a really good mix of material, actually. It gives us like the 360-degree view almost.
Yeah.
We'll be digging into the tech side, the vulnerabilities in the code itself, the operational risks of the platforms running these things.
Scams. Can't forget those.
Oh, yeah, the scams. The complexity that regulation throws into the mix, and like you said, the practical headaches of just trying to figure out the taxes on all this.
Each source really adds a different piece to the puzzle. So our mission today, it's straightforward, but really important, I think. We want to unpack this whole yield farming idea, show why those high rewards are so tempting.
Because they really are.
They are. But then, using the details straight from these sources, we need to expose and really explain the even higher risks that come along for the ride.
Getting into the nitty-gritty of the dangers.
Exactly. So by the end of this, you, listening, should have a really comprehensive, well-informed picture of what's actually going on, what's really at stake here. Okay. Let's dive in. Let's unpack this world.
All right, so yield farming. At its core, what is it? Based on our sources, it's essentially about trying to maximize your returns by participating in these decentralized finance DeFi applications.
Right.
And the main way you do that is by providing liquidity. You take your crypto tokens, your ETH, your stablecoins, whatever, and you deposit them or stake them into these DeFi protocols.
And why these protocols need our tokens? What's the point of us giving them liquidity?
Well, it's fundamental to how a lot of them work, especially the decentralized exchanges, the DTEXs. See, unlike a traditional exchange where you need a buyer and seller to directly match up, DTEXs often use something called liquidity pools.
Right. I've heard that term.
Yeah. So these pools are just big digital pots filled with pairs of assets, say ETH and USDC, and they're filled by users like you and me, the liquidity providers. This pool of assets is what allows traders to come along and instantly swap one token for another. They trade against the pool, guided by these automated market maker algorithms. They don't need someone else waiting on the other side to take their exact trade at that exact moment.
So our staked assets are basically the fuel for these DX.
That's a great way to put it. Exactly. They're the vital fuel that lets these automated peer-to-peer swaps happen through the smart contracts on the blockchain. Right. Without enough liquidity, these exchanges would grind to a halt or the prices would be terrible.
Right. Swaps would be impossible or just way too expensive.
Precisely.
And in return for providing this crucial service, this fuel, you, the liquidity provider, you earn rewards.
And that's the hook. That's where the massive appeal comes from, which is super clear in the sources we looked at.
Yeah.
Yield farming is often pitched as offering, quote, staggering returns. The potential for rewards that could far exceed that of any conventional investment.
I mean, one source even mentioned some presumably very savvy or maybe just lucky investors claiming returns upward of 500%.
Yeah, and while you got to take numbers like that with a huge grain of salt, they usually involve extreme risk. It just shows the kind of potential that pulls people in.
Totally. It's a powerful magnet, especially, when traditional savings accounts are paying next to nothing.
Exactly. A 500% APY, even if it's super risky and temporary, makes a 5% savings account look, well, irrelevant.
Right. So how are these rewards actually paid out? What do the sources say?
Okay, primarily two ways based on the material. First, you might earn what they call interest. This is usually paid out in more of the same token you deposited. So if you put in ETH, you might just earn more ETH back over time.
Okay, straightforward enough.
Or the other way is you could get paid in a different cryptocurrency altogether. Often this is the platform's own native token, maybe a governance token that lets you vote on changes or some kind of utility token.
Ah, okay. And what about the trading fees? I thought that was part of it too.
It is. That's the other really significant piece of the yield pot.
Yeah.
When traders use the pool you put liquidity into, they pay a small fee for every swap. A chunk of those fees then gets distributed back to all the liquidity providers in that pool, usually based on how much liquidity you provided. So you're literally earning from the trading activity you're helping to enable.
So, okay, the potential for high yield coming from interest, platform tokens, trading fees, that's the engine driving this whole thing. That's why anyone would even consider putting their assets into, internet code.
Right.
And this is the big, but this very potential is like completely tied up with the risks, the significant, often really unique risks involved.
Inextricably linked.
Yeah. As the sources keep hammering home, this is absolutely not like depositing your money in a bank account that's FDIC insured or something.
That distinction is so critical. It really sets the stage for understanding the risks properly.
Yeah.
One of our sources, I think it was Kraken, puts it really bluntly. Depositing assets in internet protocols is not the same as placing money on a trusted exchange or a bank.
That sentence really says it all, doesn't it?
It does. It just underscores the fundamental difference in the underlying plumbing, the safety nets, or often the complete lack of traditional safety nets.
Yeah.
The sources we read, they all emphasize this reality that, okay, with innovation comes a unique set of challenges. Operating in DeFi means you're navigating a volatile and unpredictable landscape.
So talking about these risks isn't just trying to scare people off.
Not at all. The sources frame it as essential. It's crucial for safeguarding the platform, sure, but more importantly, it's about protecting the user's assets that are locked up in these systems.
Okay, all right. Let's start drilling down into those risks then, starting with the technical vulnerabilities, the problems baked into the core DeFi protocols themselves. We're leaning heavily on the Kraken source here, right there.
Yeah, that one had a good breakdown. And first up, maybe the most fundamental one, smart contract vulnerabilities.
The code itself?
Exactly.
Yeah.
The whole DeFi operation hinges on these smart contracts self-executing bits of code on the blockchain. But, and this is the key point the source makes, they are human-written code.
And humans make mistakes.
Always. Where there's human code, there are going to be bugs, errors, oversights. It's inevitable.
And in DeFi, a bug isn't just like a website glitch. It can be much worse.
Oh, way worse. Because these contracts directly control potentially billions of dollars worth of assets locked inside them. A vulnerability isn't minor. It can be absolutely catastrophic.
Right, because there's no central off switch. No bank manager you can call to stop a bad transaction if the code has a flaw.
Precisely. Hackers, malicious actors, they are actively looking for ways to take advantage of poorly written code. The source calls these smart contracts potential single points of failure. If a hacker finds a weak spot, they can exploit it to just drain all the funds held in that contract. We've seen this happen over and over again.
Yeah, the headlines are full of it. And the fallout goes beyond just the lost money, doesn't it? The source mentioned that.
It does. Obviously, there are the significant financial losses for the users and maybe the platform developers, but it also causes huge reputational damage.
Right. Who's going to trust a protocol after it's been hacked like that?
Exactly. And depending on the situation, the jurisdiction, there might even be legal repercussions for people behind the protocol. The source really stresses that platforms need to be proactive here, rigorous code audits, ongoing analysis, managing this exposure.
Okay, so code bugs are a massive risk. What about collateralization issues? How does that play into the risk landscape?
A lot of DeFi involves lending and borrowing. You put up asset A as collateral to borrow asset B. The whole system's stability relies on the value of your collateral, asset A staying high enough to cover the loan, asset B.
Makes sense.
But as the sources point out, crypto markets are famously volatile. And during those times of intense volatility, the source says liquidity is often put to the test.
So if the price of my collateral, asset A, suddenly tanks,
The protocol might need to automatically sell your collateral, liquidate it, to pay back the loan of asset B before the collateral value drops too low.
okay.
But what if the market is crashing incredibly fast? Or what if the price information the protocol is getting from things called oracles is delayed? Or the blockchain network itself is super congested, slowing everything down?
Then the liquidation might not happen in time, or it might happen at a terrible price.
Exactly. The source notes that price can fluctuate wildly, and crucially, during these chaotic moments, funds may not be accessible when needed, either for the protocol to liquidate properly or for users to add more collateral or manage their position.
It sounds kind of like a digital version of a bank run or a margin call nightmare.
That's a pretty good analogy, yeah. If everyone rushes for the exits at once or collateral values just plummet across the board, the system's ability to handle that stress gets seriously tested.
Do platforms try to mitigate this?
They do. The source mentions some common strategies, like requiring over-collateralized loans, meaning you have to put up, say, $150 worth of collateral to borrow $100.
Right, a buffer.
Exactly. And using dynamic interest rates that go up automatically when lots of people are borrowing to try and balance supply and demand.
But that buffer, the over-collateralization, it's not foolproof, is it? Especially in a really extreme, fast crash, if the system itself jams up?
No, it's not foolproof. It adds a layer of safety, but it doesn't eliminate the risk in what people call black swan events, those extreme, unexpected market moves. Especially if, like you said, the liquidation mechanisms themselves fail due to network issues or problems with those price oracles, which are their own technical risks.
Okay. What about counterparty risk? I thought the whole point of DeFi was to get rid of the need to trust a specific counterparty.
That is the core promise, isn't it? Peer-to-peer, mediated by code, no need to trust the person or entity on the other side of your trade.
Yep.
And for many pure on-chain swaps using an automated market maker, that traditional counterparty risk, the worry that the other guy won't pay up or deliver, is largely removed by the code. But the sources point out it's not quite a universal truth across all platforms calling themselves DeFi. Certain models, the Kraken source says, like hybrid exchanges that might use some centralized components for things like order matching, may still have exposure to forms of counterparty risk in their operational flow.
Interesting. And that same source gave a way to kind of gauge trust, even in supposedly decentralized systems, right? By looking at prices.
Yeah, it suggests trying to evaluate the level of trust the market has placed on a counterparty, or maybe more accurately, on a platform by just observing market behavior, specifically comparing prices for the same asset pair across different platforms.
How does that work?
Well, if you consistently see that, say, ETH is significantly cheaper to buy on Deck A compared to Deck B, even after you account for the trading fees, that price difference might actually be a risk premium.
Meaning the market demands a discount to trade on DEX A because it's seen as riskier.
Potentially, yes. It could signal that traders perceive higher operational risks, maybe security worries, or just less confidence in DEX A compared to Deck XB, so they're only willing to trade there if they get a better deal.
Huh. That's a subtle but interesting market signal the source highlights.
It is. Okay, next risk. Governance risk. If the code rules everything, who gets to change the code? Who makes the rules?
Yeah, that seems pretty important.
It's huge, and it's this fascinating area where DeFi tries to decentralize power, but ends up creating new kinds of challenges. The source points out, the entity who sets the rules of the platform has a great deal to do with the associated risks.
So who usually sets the rules?
Often, protocols start out with a more centralized team or foundation behind them. The source mentions Maker and Synthetics foundations as examples of initial, more central structures that control parameters and updates early on.
But the goal is usually to decentralize that control over time, right?
That's usually the stated goal, yes. The trend is towards transferring power democratically to their respective communities. This typically happens through governance tokens.
So holding the token gives you a vote.
Exactly. Holders can propose changes, things like adjusting fees, changing collateral requirements, even approving major code upgrades, and then vote on them. The idea is to decentralize the risks by spreading out the control and decision-making power among all the token holders.
I get the principle, avoid one single point of failure or control. But doesn't that just shift the risk? What if, like, a few big whales who hold lots of tokens team up to push through a bad change? Or what if most voters just don't understand the technical implications of what they're voting on?
That's precisely the double-edged sword the sources hint at. You remove the risk of a single central authority acting badly, but you introduce new risks tied to collective decision-making in these really complex systems.
Like voter apathy or uninformed voting.
Or concentration of voting power, yeah. It really requires an active, informed, engaged community of token holders for that decentralized governance model to work safely and effectively. It's a big challenge.
Okay, last one under these core protocol risks. Liquidity pool dynamics. This sounds like it's leading us straight into impermanent loss territory.
It absolutely is. The Kraken source notes that price discrepancies in automated market maker exchanges are attractive to arbitrageurs. And we sort of touched on this, but it's the key mechanism driving changes inside a liquidity pool.
Right. So if the price of ETH versus CRO in a pool on DEX-A drifts away from the global market price found on, say, Binance or Coinbase.
An arbitrager will spot that instantly. If ETH is effectively cheaper in that DEX-A pool, they'll buy ETH from the pool by adding CRO to it. Then they'll immediately sell that ETH for a profit somewhere else where it's priced higher.
And this buying and selling by the arbitrageurs is what forces the pool's price back into line.
Exactly. It's the market mechanism that automatically rebalances the ratio of assets within the liquidity pool, bringing its implied price back towards the external market price.
And that constant rebalancing act, performed by these arbitrage traders, is what Kraken meant by the activity. Eventually creates a permanent loss once the liquidity is withdrawn.
That's the connection, yes. We'll dive much deeper into impermanent loss in a bit. Yeah. But the fundamental dynamic is the pool is designed to automatically adjust the quantities of the assets it holds based on external price shifts. This adjustment changes the compositions of your share in the pool. And that change might leave you with less overall value compared to if you just held your original assets outside the pool while the price moved.
Gotcha.
The source does mention that using stablecoins have become an attractive solution for these pools.
Because the prices don't change much relative to each other.
Right. If you have a pool of USDC and DAI both aiming for $1, there's less volatility among prices, so the need for drastic rebalancing is much lower, which helps mitigate this specific dynamic.
Okay, so we've covered risks baked into the protocols. The code, the lending mechanics, the governance, the pool dynamics. But our sources also highlight risks associated with the actual platforms, the websites, the interfaces, the companies maybe that run these protocols. The Founder Shield source had a good breakdown of these, right?
Yeah, it's not just the underlying smart contract, it's the whole ecosystem around it. And cybersecurity threats at the platform level are a huge one. DXs are described as being prime targets for hackers due to the high-value assets they manage.
Makes sense. They're like digital treasure chests.
Pretty much. And attackers aren't just looking at the smart contracts. They're exploiting weaknesses in the platform's website, its back-end servers, how it connects to user wallets, anything they can find.
Leading to
similar outcomes to protocol exploits. Significant losses of user funds and service disruptions, just attacking a different layer of the stack. The source also flags data breaches as a risk.
Even in DeFi, I thought it was supposed to be more anonymous.
Well, even if the core protocol aims for decentralization, the platforms themselves often collect user data, maybe as personal info during a Know Your Customer KYC check if they implement one, or maybe just transaction histories for their own analytics or operational needs.
Right. Interacting via a slick web interface often means giving up some data.
It often does. And if that data gets breached, you're looking at the same problems as any traditional tech breach. Risk of identity theft, loss of trust, and potential regulatory penalties if they violate data privacy laws. It's a risk people might overlook when just thinking about the smart contracts.
Okay. Next big platform risk. Regulatory uncertainty. This feels like a massive, constantly shifting problem for anyone trying to run a platform in this space.
Oh, absolutely. The source points out that laws and guidelines for cryptocurrencies and DeFi vary widely across jurisdictions. Imagine trying to operate globally or even just trying to comply within the U.S. where different agencies might have different views and things are still evolving. It's incredibly complex.
And getting it wrong could be fatal for the platform.
Definitely. The source mentions potential consequences like hefty fines, legal actions, or even operational shutdowns.
And they face specific legal challenges, too, trying to fit into existing frameworks.
Yes, things like complying with existing security laws, anti-money laundering requirements, and know your customer regulations. The Founders Shield source really stresses that failing here leads to lawsuits, reputational damage, and barriers to operating in key markets. It's this constant tightrope walk for platforms trying to innovate while staying compliant as regulators worldwide scramble to figure out how DeFi fits or doesn't fit into the old rules.
We talked about market volatility affecting the pools, but the Founders Shield source says it hits the platforms more broadly, too.
It does. Beyond just the mechanics of impermanent loss, crypto's extreme price volatility creates just plain significant operational challenges for the platforms. It directly impacts everything: the amount of liquidity available, the trade volumes going through the platform, and maybe most crucially, overall user confidence.
So during those big market crashes,
Yeah, those crashes, which are unfortunately pretty common in crypto, have cascading effects. Obviously, they cause significant losses for users who are holding assets or trading on the platform at the time.
which then erodes trust.
Exactly. It diminishes trust in the platform. People might blame the platform or just lose faith in crypto altogether and walk away. This directly impacts the platform's long-term viability and competitive standing. If your users got wiped out during a crash while using your service, they might not come back.
Makes sense. Then there are operational risks. This seems more straightforward, like just technical problems, outages.
It is straightforward in concept, but the impact is magnified because it's finance. These platforms rely on complex infrastructure, servers, databases, connections to the blockchain, user interfaces. All of it is susceptible to technical glitches, network congestion, and other unforeseen failures.
And if the platform goes down.
Users can't get to their money. They can't manage their positions. They can't make trades they need to make, especially if the market's moving fast. Prolonged outages can disrupt trading, frustrate users, and result in financial losses, the source says.
It's like the New York Stock Exchange suddenly going offline, but maybe without a clear regulator stepping in to sort things out.
That's a good way to think about it. And the hit to user trust and experience is immediate and painful, which leads right into the last platform risk mentioned: reputational risks.
This just feels like the sum of all the other risks, doesn't it?
It really is. The source emphasizes that any of these negative events we've talked about, a security breach, a regulatory fine, a major outage, users losing big money, can severely harm a DEX's reputation.
And reputation is everything in this space, paradoxically.
It is.
Yeah.
Even in a trustless system, users still need to trust that the protocol works as intended and that the platform providing access is reliable and secure.
Because even if the smart contract is perfect code, if the website you use to interact with it gets hacked or is always down, you're stuck.
It's exactly right. So a loss of trust hits the bottom line directly. It drives users away, probably to competitors. And the source notes, competition is fierce in the DX world. A single negative incident can wipe out a platform's competitive advantage and make it really hard to win back users and market share.
Okay, wow. So risks at the protocol level, risks at the platform level. Now let's dedicate some real time to one specific risk that's absolutely critical for anyone thinking about providing liquidity, the core activity in yield farming: impermanent loss, ILMAL. This one seems to confuse a lot of people.
It's probably the most unique risk to being a liquidity provider, or LP, in one of these automated market maker pools. And yeah, definitely misunderstood often. Our Crypto.com source defines it pretty well. It refers to the temporary decrease in value experienced when providing liquidity. But here's the key part, compared to just holding the assets yourself outside the pool.
Right, that comparison point is crucial. It's not always about losing money from what you put in initially, but about how you perform relative to just holding.
Precisely. And IL happens because the relative value of assets in a liquidity pool changes over time. Remember we talked about arbitrageurs constantly rebalancing the pool?
Yeah.
When the price of one asset in your pair, say ETH, goes way up or down compared to the other asset, say CRO, those arbitrage traders jump in, they buy the now relatively cheaper asset from the pool and sell the relatively more expensive one to the pool. This action automatically adjusts the ratio of ETH and CRO held within the pool to match the new market prices.
So if I put in 50-50 value of ETH and CRO, and then ETH moons while CRO stays flat, the pool automatically sells some of my ETH for CRO to keep things balanced according to its formula.
That's exactly what happens. The pool follows a rule, often the constant product formula, X times Y equals K, which forces this rebalancing. So when you eventually go to withdraw your share of the pool, you won't get back the exact same number of ETH and CRO tokens you put in. You'll get back a different mix that reflects the pool's new rebalanced ratio.
And the difference in value between what I get back and what I would have had if I just held my original ETH and CRO. That's the impermanent loss.
Yes, the discrepancy between the initial deposit and the value at withdrawal, calculated at that moment, is the impermanent loss.
And why impermanent?
Good question. It's called impermanent because, theoretically, if the prices of ETH and CRO were to swing back to the exact same ratio they were at when you first deposited, the impermanent loss would technically disappear. It only becomes a realized or permanent loss if you actually withdraw your liquidity while that price difference exists.
Yeah.
In super volatile crypto markets, waiting for prices to perfectly revert, well, that might be a long wait, or it might never happen.
Right. That Crypto.com source had a really useful, detailed example walking through the math with ETH and CRO. Let's try and break that down step by step, make it really concrete.
Okay, let's do it. So imagine Ella joins an ETH Crow liquidity pool. At the time she joins, 1 ETH is worth 1,000 CRO. She decides to deposit 5 ETH and 5,000 CRO.
Okay, so that's equal value at the start, right? 5 ETH, 1,000 CRO at this 5,000 CRO, plus the 5,000 CRO she put in. Total deposit value, 10,000 CRO.
Exactly. And let's say her deposit represents 10% of the total liquidity in that pool. So the whole pool, hypothetically, started with 50 ETH and 50,000 CRO.
Got it. Alice has a 10% stake.
Now, the market goes wild. The price of ETH doubles. Now, 1 ETH is worth 2,000 CRO.
Okay.
Arbitrageurs immediately see ETH as too cheap inside this pool compared to the outside market. They'll start buying ETH out of the pool by depositing CRO into the pool. This forces the pool's internal mechanics, the AM, to rebalance. It adjusts the amounts of ETH and CRO it holds to reflect the new 1 ETH equals 2,000 CRO price while keeping that constant product XYK intact.
So the pool ends up holding less ETH and more CRO than it started with.
Precisely. The source calculates that after rebalancing, the pool might now hold something like 35.355 ETH and 70,710.678 CRO. It maintained its K value but adjusted the asset ratio to match the new price.
Okay, less ETH, more CRO. And Alice still owns 10% of what Edo's in the pool.
Right, so now Alice decides she wants to withdraw her share. She gets back 10% of the pool's current holdings, that's 3.5355 ETH, and 7,071.0678 CRO.
All right, now what's that worth at the current market price of 1 ETH equals 2,000 CRO?
Let's calculate. 3.5355 ETH, 2,000 CRO is 7,071 CRO, plus the 7,071.0678 CRO, she also got it. So the total value she withdrew is roughly 14,142 CRO.
Okay, 14,142 CRO. She started with 10,000 CRO worth, so she made money overall in this case because ETH went up so much.
She did make money compared to her starting point, but here's the IL calculation. What if Alice had never put her assets in the pool? What if she had just held her original 5 ETH and 5,000 CRO?
Okay, let's see. At the new price of 1 ETH equals 2,000 CRO, her 5 ETH would be worth 10,000 CRO. Plus, she still has her 5,000 CRO, so holding would have given her 15,000 CRO total value.
Exactly. So she withdrew 14,142 CRO from the pool. But if she had just held, she'd have 15,000 CRO worth of assets.
The difference is 15,000 minus 14,142, which is 858 CRO. That's the impermanent loss.
That's it. In this scenario, where the asset price went up, she didn't lose initial capital, but she ended up with 858 CRO, less value than she would have had by simply holding. It's an opportunity cost, essentially.
Okay, that makes sense. And this really highlights that confusion we saw discussed in the Reddit source, the difference between IL and actually losing your initial investment.
Yeah, those forum discussions were helpful. IL is often framed and felt by users as missing out on gains compared to just holding, like in Alice's example. It's not always a loss against your starting capital. You only realize a capital loss in your principal if the overall value of the assets drop significantly below where you started and you pull your money out then.
Right. A user on Reddit asking about an XPR USDC pool got a really clear answer on this. Something like, your losses are limited to the amount you put in. You cannot go underwater, assuming you didn't borrow to get in.
That's such a crucial point from the source. Unless you're using leverage, borrowing money to yield farm, which is a whole other layer of risk, the mechanics of IL itself won't make you owe money. Your maximum loss from the pool rebalancing effect is capped at your initial deposit. The Reddit example showed that as the XPR price moved against USDC, the amounts of each token you'd get back change, potentially giving less total value than holding, but not creating debt.
So understanding IL really means seeing it as this relative performance thing against just holding, not necessarily always losing principal. What affects how bad the IL might be? The Crypto.com source listed some factors.
Yeah, first is pool composition.
Yeah.
Pools that contain assets whose prices tend to move together, they have high correlation, or pools pairing two stablecoins, generally experience lower IL.
Why is that?
Because if both assets go up or down together, or if they're both pegged to $1, the relative price difference between them doesn't change as much. Less relative price change means less need for the pool to rebalance drastically, which means less IL.
Okay, so like an ETH-wrapped Bitcoin pool might have less IL than, say, an ETH Shiba Inu pool because ETH and BTC prices are generally more correlated.
Exactly. And a USDC DII stablecoin pool should have very minimal IL because they're both aiming for $1, so their relative price barely moves.
Makes sense. What else affects IL?
Second factor is time horizon. Like we said, IL is technically temporary. The source notes that over time, the loss can be mitigated or even eliminated if the relative values of the assets revert to their initial levels. So if you stay in the pool long enough and the prices happen to swing back to their original ratio,
the IL shrinks or disappears, but that's a big if in crypto, right? Betting on prices reverting perfectly.
It's definitely speculative. And third, the source mentions just staying aware of market trends. Things change fast, new assets launch, market sentiment shifts, protocols get updated, all of which can change the risk-reward profile, including the IL potential for different pools.
Are there things LPs do to try and, fight back against IL strategies to reduce it or offset it?
Yeah, the source outlines a few common approaches. One is simply being selective. Carefully select the pools you enter. If minimizing IL is your main goal, focus on those pools with highly correlated assets or stablecoin pairs.
Okay.
Another strategy is diversification. Diversifying liquidity across several different pools instead of putting everything into one volatile pair spreads the risk around.
Don't put all your eggs in one potentially IL-heavy basket.
Basically, yeah.
Yeah.
And then, really importantly, considering potential returns from trading fees. Remember, the main reason you're providing liquidity is to earn yield, and a big part of that yield comes from your share of the trading fees.
Right.
The source points out that these earned fees can, and hopefully do, potentially offset IL. In pools with lots of trading activity, high trading volumes and fees, the fees you earn might be enough to cover any impermanent loss and still leave you with a profit.
So it's a calculation. Are the fees I'm earning likely to be bigger than the potential IL I might suffer due to price swings?
That's the core calculation LPs are constantly making. The goal is for fees IL.
So the very volatility that causes the IL could also drive more trading volume, generating more fees that offset the IL. It's kind of a weird push-pull.
It is a complex relationship, and that direct link between volatility and IL is key. The source is explicit. High levels of volatility mean the potential for IL increases simply because the relative prices can swing much more drastically and quickly. Highly volatile assets may result in higher IL.
Which brings us back to why stablecoin pools are popular for lower IL. Low volatility between the paired assets means less rebalancing needed, hence less IL generated.
Exactly.
Okay, so impermanent loss is this weird inherent risk of the LP mechanism itself. But there's another category of risk that's much more, malicious and potentially just as devastating: yield farming scams.
Ugh, yeah. Our source from Esson covers this grim topic. They define these scams pretty simply as criminals using fake or hacked platforms to steal money from investors who are chasing those high DeFi profits.
And the classic example, the one that's almost infamous in crypto circles, is the rug pull, right? The source tells a story of how that typically goes down.
It's a depressingly common pattern. Step 1. The scammers create a DeFi crypto platform. And the source notes, this can be disturbingly easy to do in a space with little regulation, maybe by just copying existing open source code.
And make it look legit, at least on the surface.
Right. Step 2, massive promotion. They hype it up using impressive returns, often unbelievably high APYs as bait. They blast this promotion out through press releases, Discord servers, Reddit, Telegram, forums, you name it. Anywhere potential victims might be looking for the next big thing.
Create that FOMO fear of missing out.
Totally. Step 3. Investors, lured by the hype and those juicy promised yields, transfer legitimate cryptocurrency, their ETH, their stablecoins, onto the scam platform's contracts or wallets, expecting to earn rewards. Step 4 sometimes. The scammers might actually pay initial rewards to the first few investors. This is clever, right? It builds fake credibility, generates positive buzz, hey, it works, I'm getting paid, and draws in even more money. Sometimes it works like a classic pyramid scheme, using new deposits to pay fake returns to earlier investors.
Just long enough to reel in more victims.
Exactly. Then comes the final brutal step, the reg pull itself. Once they feel they've collected enough crypto, the scammers simply withdraw all of the liquidity from the platform. Because they control the keys or the malicious code, they can just drain everything valuable.
leaving the investors holding
What?
empty bags.
Pretty much. They're left with worthless tokens. Often the rewards paid out, or the LP tokens representing their stake, were just garbage tokens created by the scammers themselves. Once the real crypto backing them is gone, they're valueless. And then poof, the platform, the website, the Twitter account, everything disappears overnight, as the source says. Victims can't even contact anyone or access records.
Just gone. Brutal. And the source mentioned it's not just completely fake platforms. Hackers can hit legitimate ones, too.
That's a really important point. Because so much DeFi code is open source, hackers can study it, looking for vulnerabilities to exploit even on established platforms. So even if the team is legitimate, there's still a hacking risk.
Yeah. The source gave some real-world examples of rug pulls, too, right?
It did. One was Arbix Finance, believed to be around a $10 million rug pull back in January 2022.
Okay.
And what's really concerning about that one, and maybe highlights how hard this space is to navigate, is that Arbix had apparently been audited by Certic, which is a well-known security firm in the Web3 space.
Wow. So even getting an audit isn't a 100% guarantee against a scam.
Apparently not. It shows that audits help reduce risk, find bugs, but they can't always catch malicious intent or every possible flaw, especially if the team itself is the scammer. A stark reminder.
Definitely. What was the other example?
Max APY from April 2022. The red flag here should have been blindingly obvious. It was promising an annual compound interest rate of, wait for it, 960,000%. Come on.
Right. If it sounds wildly too good to be true, it almost certainly is. Unsurprisingly, the source says their social media vanished. The native token price crashed 67%. Classic rug pull. Users left holding the bag.
Those insane APYs are definitely warning sign number one. What other red flags does the source say to watch out for? Well, besides the extremely high returns that just defy logic, be suspicious of excessive, sudden promotional material all over the web, especially if it feels like paid hype rather than organic community interest. Look closely at the platform itself. Hastily thrown together websites with poor grammar or sloppy design can indicate a rushed scam. And critically, is there no way for you to do due diligence on the people behind the project? Anonymous teams are a huge red flag because they can just vanish without a trace after pulling the rug.
Right. No accountability. So given how dangerous these scams are, what's the advice for trying to avoid them?
The number one piece of advice from the source is pretty fundamental. Only get involved in yield farming if you're confident in both your cryptocurrency knowledge and technical ability. This is not a playground for complete beginners who don't understand how wallets, smart contracts, and blockchains work.
Fair enough. And stick to known platforms.
Yeah, sticking with well-established and regulated platforms is generally recommended. But even then, the source adds a really important caveat, which is that even on platforms that seem trustworthy, it remains difficult to eliminate risk entirely in this space. And they specifically mention the collapse of big, seemingly stable players like FTX as a painful reminder that major risks, fraud, mismanagement can still blow things up unexpectedly, even with established names.
So even the big guys aren't immune?
No. The overall message is be extremely cautious, do your homework relentlessly. That DYOR, do your own research mantra is absolutely critical here.
Okay, so scams are a huge, nasty layer of risk. Let's shift gears again to another major source of risk and complexity, this time involving the authorities. Regulatory risks. Especially thinking about the U.S. context. We have insights here from that U.S. Treasury report from 2023 on illicit finance risk in DeFi.
Yeah, that report was significant. According to the Treasury itself, it was the first of its kind globally to really focus just on illicit finance risks within DeFi. The stated goal was to understand how criminals and other illicit actors might be exploiting services that fall under the DeFi umbrella.
And the Treasury had its own definition of DeFi. They mentioned it sometimes used a bit loosely.
They did. So, reporting impartially straight from the document, the Treasury defines DeFi broadly. They say it refers to virtual asset protocols and services that purport to allow some form of automated peer-to-peer transactions, often through use of self-executing code known as smart contracts based on blockchain technology.
Okay, pretty standard definition.
But then they add this crucial observation. They note that the term DeFi is frequently used loosely by the private sector, often for services that are not functionally decentralized.
That's a key distinction from the Treasury's perspective. They're looking at things called DeFi, which might not actually be fully decentralized in practice. So who did the report find was using these services illicitly?
Again, just reporting the findings stated in the assessment. It says actors like the Democratic People's Republic of Korea, DPRK, Cybercriminals, ransomware attackers, thieves, and scammers are using DeFi services to transfer and launder their illicit proceeds. This is presented as a factual finding based on their analysis. We're just conveying that information here neutrally.
Understood. And the report identified specific vulnerabilities in DeFi that, from the Treasury's viewpoint, allow this illicit activity to happen.
Yes. The assessment points to the primary vulnerability as stemming from what it describes as non-compliance by DeFi services with AML-CFT, anti-money laundering, and countering the financing of terrorism and sanctions obligations.
Okay.
And the report makes the Treasury's position very clear on this. It states that DeFi services engaged in covered activity under the Bank Secrecy Act have AML-CFT obligations regardless of whether the services claim that they currently are or plan to be decentralized.
Wow. Okay. That's a really direct statement from the Treasury in that document, essentially saying, if your activities fall under existing U.S. financial regulations like the Bank Secrecy Act, just calling yourself decentralized doesn't automatically get you off the hook from complying.
That's the stance presented in the report, yes. It also identifies other vulnerabilities, like the possibility that some DeFi services might genuinely fall out of scope for existing AML-CFT obligations, the problem of weak or non-existent AML-CFT controls for DeFi services in other countries, and also just poor cybersecurity controls, which allow funds to be stolen in the first place, which then need laundering.
So the report didn't just point fingers, it also suggested what the U.S. government should do about these risks.
It did. It included recommendations for U.S. government action aimed at tackling these identified illicit finance risks. Again, reporting impartially, these recommendations include things like strengthening U.S. AML-CFT regulatory supervision, considering additional guidance for the private sector on what their AML-CFT obligations actually are in DeFi, and assessing enhancement to address any AML-CFT regulatory gaps related to DeFi.
So looking at potentially clarifying or even expanding the rules.
That seems to be the direction indicated by the recommendations in the report. And it mentions this builds on earlier work, like Executive Order 14067. We're just presenting these as the recommendations laid out in the government's assessment.
Got it. So regulatory risk isn't just about accidentally breaking current rules. It's also about the government actively watching, defining problems from its perspective, and potentially changing the rules or stepping up enforcement. That's a lot of uncertainty for platforms and users.
It is.
And for individual users, another huge area of complexity and, frankly, risk is taxes, especially here in the U.S.
Oh boy, taxes. Yeah, our source from CoinLedger really digs into this particular headache, and they start by highlighting the core problem. The IRS hasn't issued clear, specific guidance on how a lot of common DeFi activities like yield farming or liquidity providing should be taxed.
No official DeFi tax rulebook yet?
Not really. And to make matters worse, these decentralized protocols generally don't send you any tax forms, like the 1099s you might get from your stockbroker or bank.
So you're kind of on your own to figure it out.
Pretty much. Tax professionals and users basically have to look at the existing general crypto tax guidance and try to extrapolate how DeFi transactions might fit into those existing rules.
And what are those general rules, basically?
Generally speaking, based on current IRS guidance interpretations, trading one crypto for another or selling crypto for dollars or using crypto to buy something, those are usually disposals and are taxable events, subject to capital gains tax.
Okay.
Earning new cryptocurrency, like through mining, staking rewards, or maybe getting paid in crypto, is typically treated as ordinary income, subject to income tax based on its value when you received it.
Right.
And just holding crypto or moving it between wallets you own is usually not a taxable event.
Okay, so how does that apply to the messy world of yield farming? Sounds like it could trigger both types of tax.
The source indicates, yes, yield farming activities can very likely trigger both income tax and capital gains tax, depending on exactly what you're doing and how this specific DeFi protocol works.
All right, let's break that down. Where does capital gains tax usually come into play with yield farming?
The act of depositing crypto into and withdrawing it from liquidity pools might be considered taxable disposals. The CoinLedger source gives a specific example, using a protocol like Uniswap v2. To provide liquidity there, you essentially trade your ETH and say your CRO for special tokens called liquidity provider LP tokens. These LP tokens represent your share of the pool.
Okay.
That act of swapping your ETH and CRO for those LP tokens, that is likely considered a taxable disposal of the ETH and CRO you put in. You'd calculate a capital gain or loss based on how the price of that ETH and CRO changed from when you first acquired them until the moment you swap them for the LP tokens.
Wow. Okay. So just getting into the pool could be a taxable event right there. What about getting out?
Similarly, when you decide to leave the pool and you redeem your LP tokens back for the underlying crypto, like getting your ETH and CRO back, though maybe in different amounts due to IL, that redemption is also likely considered a taxable disposal this time, a disposal of the LP tokens themselves. You then have a capital gain or loss based on how the value of those LP tokens changed from when you first received them until you redeemed them. And importantly, that gain should technically reflect the value of any trading fees or other rewards that accrued to your share and increase the LP token's value while you held it.
Good grief. So potentially two separate capital gains events just for entering and exiting the pool via LP tokens, depending on how asset prices and the LP token value moved.
That's the interpretation based on existing guidance, yes.
Right.
And of course, any other disposals, like selling the crypto you eventually get back from the pool or trading it for something else, would also be standard capital gains events.
Okay, that covers capital gains. Where does the income tax part come in?
Income tax generally hits when you earn new crypto tokens as rewards, separate from just trading assets you already owned.
Like the interest or platform tokens we talked about earlier.
Exactly. If a protocol just gives you, say, its governance token or a share of trading fees paid out in crypto, simply for having staked your liquidity and you didn't have to actively trade something to get that reward within the protocol, that reward is likely considered income.
So it's like getting paid for providing the service of liquidity.
Pretty much. The source uses MakerDAO, giving users DAI stablecoins for providing liquidity as a potential example of something treated as income. These earned rewards are likely taxable as ordinary income, and the amount of income is based on the crypto's fair market value at the exact time you received it.
Okay, but wait, then if I later sell or trade that crypto I got as income, is that taxed again?
Yes. That's the stacking effect that makes it so complicated. If you later dispose of the crypto you received as income, say, you sell those DAI tokens you earned, that sale is then treated as a separate capital gains event.
Oh, man.
Your cost basis for that sale would be the fair market value of the DAI when you first received it as income. And you'd have a gain or loss based on how its price changed between receiving it as income and eventually selling it.
This sounds unbelievably complex to keep track of manually. Every deposit, every swap for LP tokens, every single reward payout, every redemption, every final sale.
It's incredibly difficult. For U.S. taxes, you need to report capital gains losses on Form 8949, and that requires listing the asset description, acquisition date, sale date, proceeds, cost basis, gain loss for every single transaction.
Yikes.
And crypto income typically goes on Schedule 1, Form 1040, under Other Income. Trying to manually track all those details across potentially dozens or hundreds of transactions on multiple DeFi platforms and wallets, it's a nightmare. Especially since, as we said, the protocols don't send you any handy tax forms summarizing it all.
So how do people cope? Does the source mention solutions?
It does mention that specialized crypto tax software has emerged to try and tackle this complexity. Tools like CoinLedger, which was the source we read, are designed to connect to your crypto wallets and exchange accounts via APIs or public addresses. They can pull your transaction history directly from the blockchain, analyze it, and attempt to automatically calculate all your capital gains, losses, and income events based on interpretations of the current tax rules. They're presented as a tool to help manage the sheer volume and complexity of tracking.
That sounds almost essential if you're doing a lot of this. And speaking of tracking, the source had a reminder about privacy, didn't it? Or lack thereof.
It did. It's a good reality check. While using DeFi might feel more private than using a centralized exchange that requires KYC, the actual transactions on most public blockchains, like Ethereum, are publicly visible for anyone to see.
Right, the blockchain explorer.
Exactly. And the source explicitly states that the IRS has worked with contractors like Chainalysis to analyze the blockchain and crack down on tax fraud. So the idea that your DeFi activity is somehow hidden from the tax authorities is likely wishful thinking.
So bottom line on taxes, it's complicated. It depends heavily on the specific protocol's mechanics. The rules are still evolving, and you probably need help.
That's the gist of it. The CoinLedger source really emphasizes that taxability hinges on the specific mechanisms of the DeFi protocol you're using. And because it's such an evolving space, with limited direct guidance from the IRS, consulting with a qualified tax professional who actually understands crypto and DeFi is highly recommended. Don't just guess.
Sound advice. Okay, so we have covered a massive range of risks. Technical code flaws, platform operational issues, security breaches, outright scams and rug pulls, the shifting sands of regulation, and the headache of taxes and tracking. It's a lot. Given all this, how do platforms and, by extension, their users even attempt to manage or mitigate these dangers? The Founder Shield source talked about strategies, including insurance, right?
Yeah, insurance comes up as one piece of the puzzle. It's described as potentially a vital safeguard for the platforms themselves. The idea is it allows them to transfer some of the financial liability associated with unforeseen events, like a hack or a lawsuit, over to an insurance company.
Frees them up to focus on building.
Potentially, yeah. Lets leaders focus on innovation instead of just worrying about disaster recovery. But the source is very clear. Insurance is just one piece of the puzzle. It's not a magic bullet for risk management.
So what kinds of insurance are relevant here? Are they special DeFi insurance policies?
Mostly, they're standard business insurance types, but their importance is really amplified in the DeFi context, according to the source. First, cyber liability insurance. This is crucial. It helps cover the financial fallout from cyber attacks, data breaches, think costs for forensic investigation, recovery, legal fees, PR crisis management, essential when user trust hinges on robust security.
Makes sense. What else?
Directors and officers, or D&O insurance. This protects the personal assets of the platform's executives and board members if they get sued over their business decisions. Super important in the high-stakes DeFi industry, especially, as the source says, when navigating uncharted regulatory waters where lawsuits are common. Good D&O coverage also helps attract top leadership talent.
Okay. There was also errors and omissions, or E&O.
Right. E&O covers claims of professional negligence or mistakes made in providing the platform services. So if users claim they lost money due to an operational error or oversight by the DX, E&O could potentially cover that. It helps reinforce the platform's credibility. And lastly, crime insurance. This protects against internal threats, employee theft, fraud, collusion. Given the huge amounts of digital assets these platforms handle, protecting against rogue insiders is a big concern.
So basically standard corporate insurance, but applied to the unique high-stakes risks of DeFi.
Exactly. But again, the source really hammers home that you can't just buy insurance and call it a day. Effective risk management has to go beyond coverage. It requires comprehensive risk management strategies and embedding proactive measures deep within the organization's culture and operations.
So what are some of those key proactive measures?
Number one, absolutely non-negotiable, robust security audits. The source stresses the need for independent expert security auditors to comb through the smart contracts, the platform infrastructure, everything, looking for vulnerabilities before the bad guys find them.
Not just a one-time check.
No, it should be an ongoing process. The source outlines the stages: scoping the audit, detailed code review, getting an initial report, fixing the bugs found, retesting, and getting a final report. Making this a regular, rigorous practice sends a strong signal that security is top priority.
And dealing with the regulatory uncertainty we talked about.
That requires a strong compliance framework. The source calls this essential for navigating that complex regulatory landscape. Having clear internal policies, a solid plan for meeting requirements, like AML-CFT or KYC if applicable, a program for assessing regulatory risks, and undergoing compliance audits. All this helps mitigate the risk of fines, shutdowns, and reputational hits.
Directly tackling that pressure from bodies like the Treasury. What about the human element inside the platform?
Huge factor. The source emphasizes building a strong risk management culture, calling it maybe the organization's greatest asset. This means creating an environment where every employee feels empowered and encouraged to spot potential risks and report them without fear. It requires training, open communication about threats, and strong leadership buy-in to make everyone feel like risk management is part of their job.
And inevitably, things will go wrong sometimes. How should platforms prepare for that?
With a well-thought-out incident response plan. The source calls this the best defense against unexpected events. It's basically a pre-planned playbook for exactly what to do when a security breach, a major outage, or some other crisis hits.
What does that involve?
It typically includes stages like preparation, having the plan ready, team trained, identification, quickly detecting an incident, containment, stopping the bleeding, limiting damage, eradication, getting rid of the root cause like malware, recovery, getting systems back online safely, and then critically, lessons learned, analyzing what went wrong to prevent it from happening again.
And finally, just keeping an eye on the horizon.
Yeah, continuous monitoring. The source stresses that staying ahead of emerging threats in a space that moves as fast as DeFi requires constant vigilance. Platforms need to be actively monitoring market trends, watching for regulatory updates globally, tracking new types of vulnerabilities that researchers are finding. Being proactive here helps platforms stay ahead of the curve.
Okay, so it's this whole layered approach. Insurance as a financial backstop, but built on a foundation of rigorous security audits, solid compliance, a vigilant internal culture, a plan for when things break, and constant monitoring of the environment.
That's the comprehensive picture the sources paint for responsible platform operation.
Yeah.
And really, all of this brings us back to that fundamental tension we started with, the whole risk versus reward balance in yield farming.
Yeah, we've seen the dazzling potential, those staggering returns that lure people in, high yields that make traditional finance look tame. And then we've spent a lot of time detailing the multitude of risks, the fragile code, the shaky platforms, the volatility, the scams, the regulators, the taxes. It's a minefield.
It really can be. And the sources suggest that something like impermanent loss, which we dissected, might need to be viewed as simply a potential trade-off for the potential rewards that liquidity provision offers.
Meaning, you accept the risk of IL hoping the yield you earn will be greater.
That's the hope. The idea is that the rewards you earn mainly from those trading fees, maybe some extra token incentives can, and ideally should, be enough to offset IL and potentially generate additional returns.
But potentially is the key word there, right? It's not guaranteed.
Absolutely not guaranteed. Making that calculation work in your favor requires, as the sources imply, a really careful assessment of that specific pool's risks versus its potential rewards. You need to understand the likely behavior of the assets in the pair, have a realistic view of market volatility, and think about your own time horizon, how long you plan to stay in.
And remembering that IL is impermanent only until you withdraw. If prices don't revert, that loss becomes real.
Exactly.
Yeah.
Relying on prices swinging back perfectly in volatile markets is highly speculative.
So it all comes back to the individual, doesn't it? You, the listener, if you're considering or already doing yield farming, understanding all these dynamics, the tempting rewards, the specific technical dangers, the platform weaknesses, the scam threats, the regulatory shadows, the tax mess, and especially those tricky mechanics of impermanent loss, it's all absolutely crucial. You need that understanding to make an informed decision about whether the potential upside truly outweighs this whole mountain of risks for your own specific situation, your own risk tolerance, your own technical skill level.
It's definitely not set it and forget it.
Yeah.
It demands significant homework, technical savvy, and frankly, a strong stomach for volatility and uncertainty.
It's not passive investing by any stretch. It requires constant awareness, active management of these really unique dangers.
For sure.
Okay, so let's try and wrap this deep dive up. Key takeaways. Yield farming in the U.S. crypto world offers that tantalizing promise of high rewards, but it comes loaded with significant, multifaceted risks.
Yeah, ranging from those deep technical vulnerabilities in the smart contracts themselves, issues around collateral and governance, right up to platform-level threats like cyber attacks, operational failures, and the ever-present danger of scams, especially rug pulls.
Plus, we have the complexities of an evolving regulatory environment, with bodies like the U.S. Treasury scrutinizing the space for illicit finance risks, and the practical nightmare of figuring out U.S. tax implications with unclear guidance and no standard reporting.
And we spent significant time on impermanent loss, that core risk for liquidity providers. Understanding it's that temporary value dip compared to just holding, driven by price changes and pool rebalancing, but potentially offset by the trading fees you earn. Potentially.
And mitigating all these risks, it requires layers. Platforms need robust security, compliance, incident planning, maybe insurance. But ultimately, it falls heavily on the individual investor needing knowledge, caution, and doing that relentless personal research.
Absolutely. So considering everything we've discussed today, straight from these sources, the sheer volatility of the assets, the technical fragility, the constant threat of scams and exploits, here's a final provocative thought for you to chew on.
Okay.
In this incredibly fast-paced, often unpredictable DeFi world, is that concept of impermanent loss actually becoming functionally permanent for many users when they finally withdraw, especially after navigating volatile markets or hitting unexpected platform issues? And if that's often the reality, how should that possibility fundamentally change how we think about and how we evaluate the true sustainable yield that yield farming actually offers?
That is a really crucial question to ponder as you navigate this complex space. This deep dive, we hope, gives you a solid foundation. But remember, DeFi and yield farming are constantly changing. Please keep learning, stay skeptical, stay vigilant, and always do your own thorough research using multiple reliable sources. Thanks so much for joining us.
Thank you.